Welcome back to Dividend Obsession. I recently started a series on my channel called Dividend Discussion that's going to allow other dividend investors to tell their story. One of the goals of this series is to allow each of us to grow through the experiences and lessons of others to make us all better dividend investors. Now, if you're watching this video, this is just a short clip from the full interview, so if you enjoy it, make sure you click on the link at the end of this video for the full interview. So the first question I have for you is, what got you into dividend investing and when did you get started?
Well, let's see. I think what I'm going to do is show my dividend history because it sort of maps out what I'm going to talk about. So if I go back to here and share my screen, on a window, this one, and can you see that one?
It says there we go, I can see it.
Okay, so I'm going to show this one because this is the one that I show if I am talking and answering this question for people. I started investing back in August of 2000. I was just divorced and my life was not really easy at that point. And this new company in Bellevue, Washington opened up. It's called ShareBuilder. And they did something that I had never heard of before. It was dollar-based investing, where you could put in $10, $25, $50, and buy as much of a share of stock that money could buy. Everybody else was saying you've got to buy 10 shares or 100 shares. And in 2000, that was a lot of money. ShareBuilder got a lot of attention by doing dollar-based investing. And I opened an account and I deposited $45. And my first investment was Texas Instruments. It's one of the only ones I still own. I didn't do that much with it over the first 10 years, as you can probably see. But then I bought AT&T, and AT&T is it's big in the dividend groups. It's not that great of a company, but it pays a decent dividend, and it always has. It's an income stock. Mm-hmm. And I put like $1,000 into it because I had a little extra out of a tax return. And that got my attention. And so for another 5 or 6 years, I built up on that. And then around 2010, you can see where this starts going up. That's when I discovered high dividends. And what I was looking at are the mortgage REITs and the ultra high 5%, 10%, 15%, even 25% stocks. Okay. And they were all the rage as far as I was concerned because this is a get rich quick mentality. Mm-hmm. And it's the American dream. You get rich quick. Mm-hmm. So I started getting rich quick, sort of. And as you can see, my revenue stream, this is annual here, and this is quarterly and monthly. So if we just look at the annual, you can see how fast it was going up. And it just kept going up. And right about in 2019, I had a friend of mine ask me to start looking at what my portfolio was doing. Not the revenue stream, the nest egg. Because there was a difference, and I hadn't understood what the difference was, or that there even was a difference. And what I realized when I looked at the stocks that I owned is that my revenue was going up, but my portfolio value was going down because the stocks that I owned were losing money over time. It looked like I was doing well because of the revenue stream, but if I ever had to cash out for an emergency or if I wanted to buy something big, I wouldn't have had enough. So that got me reworking my ranking list away from high dividends to what I called total growth. And what that meant to me is focusing on what a company has been doing over the last 10 years in terms of dividend growth and price growth. And what I found is a resource for that raw data. Seeking Alpha was the best one that I found because they literally mapped it out. They showed you in numbers what the dividend growth rate was for 1, 3, 5, and 10 years, and then what the momentum was for both regular price and total return, and there's a difference between the two,
Mm-hmm.
for 1 month, 3 months, 6 months, year to date, and then 1, 3, 5, and 10 years. So I looked at the stocks that I had on my portfolio, and I added in all the numbers. All of this was manual entry. I don't have enough coding skill to be able to do any of this automatically. But once I finished filling in the 1, 3, 5, and 10-year data for dividend growth and price growth total return for all of the stocks that I had been buying because of their high dividends, and I ranked them based on how well they've been doing, I found that most of the ones that I had were at the very, very bottom of the list. They were the worst stocks for me to own if I wanted to get growth out of my portfolio.
That's where you just change the filter to the other way, and then they're the top ones.
Yeah, that's what I had been doing. Is
Yeah.
I've been focusing on the high dividend income stocks that were not growing. And when I looked at the data and said, okay, so which stocks are growing? Which ones should I buy if I want to change my strategy like that? And I'll share my screen again so we can see what happened. I dropped my revenue stream from just over 3,000 to just over 300. I dropped it by 90%.
Hmm.
And that was in June of 2000. And right about there. And I
June of
watched my
2020.
portfolio revenue stream drop for about a year, and then it started going up again. And this is what I'm doing now, is tracking it every single transaction. And this spreadsheet has everything if we really want to dive into it deep. But I'm watching my annual, quarterly, and monthly averages go up over time. And I'm growing at about 25%.
Yeah.
Which is honestly pretty good.
Yep, that's really good. So it sounds like my next question was going to be, what type of investor would you say you were when you started, which we know it looks like you were a yield investor.
Well, when I first started, the first 10 years is what I call a dartboard strategy. I was just throwing darts at whatever looked good on the board.
So I started with Robinhood, and
Yep.
I remember my stock filtering strategy was quite literally I think there was a tab at the bottom, like somewhere in the middle, that would show you like the biggest winners and losers of the day.
Yes.
That was my strategy. Because if this stock won, whatever stock it was, if it won today, it's got to win tomorrow. Like that's how science works. So that was that was my strategy.
Yep.
So question for you then, because I know, being in the groups that we're in, a lot of people when they first get started in dividends are attracted to that high yield. What do you think? What do you think causes that?
Honestly, I think it's the get rich quick mentality that the United States pushes on people. We see, I mean, in the 1980s, there was this television show, The Lifestyles of the Rich and Famous, and everybody wants to have the mansion. Everybody wants to have the Lamborghini. Okay. And the fastest path that you can get to that really looks good. And when people are just starting in the markets and just starting with investing, if they see that they can get a 10 or 15% return, then that's what they want. The problem is that that's a snapshot number in time. Okay. As of today, with the way the stock value has been, if you take the dividends over the last 12 months and divide those by the stock value, you're going to get 10, 15, 20%. But what that doesn't tell you is what that stock value is going to do in the future. Because if your dividend yield is 20%, and we could do math if you want to, but if that stock value continues to go down, your dividend yield is going to look like it's still going up. Mm-hmm. But the dividend number is not going to change. Mm-hmm. And if a company is losing value in the market, if their stock price is going down, that means that the market doesn't like them. It means that the people who invest in the market, the institutional investors, they are looking at the fundamentals of that company and saying, I'm not buying that stock. In fact, I'm selling what I've got, because if I keep my capital in that investment, it's going to lose value over time. It's going to lose me money.
Mm-hmm. Yep.
So that's where the dividend yield can be nothing but a trap.
Mm-hmm.
Now, we're talking extreme cases, but when you talk about 10% or 15% yielding stocks, yeah, those are the extreme cases.
Yeah. Well, and the thing that I always try to explain to people, especially those that are newer into dividends, is just because somebody makes a lot of money in their dividend portfolio doesn't necessarily mean they know what they're doing, for that exact reason. Because you can put a small amount of money into dividend stocks and make a relatively decent amount by chasing those higher yielders, those 10, 15, 20% yielders. But that doesn't necessarily mean, and those are the people, I mean, you have a YouTube channel as well, Total Growth Investing. Those are the people that seem to get the quicker followings and stuff like that, because they're, oh, here's this list of 5 stocks that are all above 10% dividend yields. But then when you actually break it down and look at these stocks, and you're just like, okay, I often say it's like, okay, this dividend company A, gave you $75 in your left hand in dividends, but then took $100 from your right hand in capital appreciation.
Yes.
So it's often like a sleight of hand trick. They're almost like magicians, where they're like, oh yeah, look over here. Don't worry about what we're doing to your right hand. Just look at your left hand. So
exactly. And that's the mistake that I was making in the late 19s, late teens, is I was looking at the $2,000, $2,500, $3,000 a year that I was bringing in dividends, and I wasn't even paying attention to my portfolio value.
Yep. That's not even, so if what Chad is saying speaks to you guys that are watching this video, that's not anything to feel shamed about, that you might be in that boat. What it is a understanding that Chad and myself have fell for this. It's common for, I'm pretty sure 90% of dividend investors at one point or another have been like, why would I buy this one stock that has a 0.5% yield when I can buy this other one that has a 4% yield?
Yeah. And to make things even muddier, nobody is saying that the particular investments that you have invested in are bad investments.
Mm-hmm.
I mean, the ones that you have picked might be the exceptions to the rule, mm-hmm. and they might make you rich.
And it's all,
if you're willing to make that risk, that's on you, and
yep.
that's your choice.
Yep.
And nobody should be able to say you made a bad choice. The only person who can say that something was a bad choice is you in 10 years when you look back on what your opportunity cost was.
Mm-hmm. Yep. Yeah, and it's one of those things where the high dividend stocks aren't always a bad idea either. It also comes down to where you are in your timeline. Are you at the point where you,
and how comfortable you are with risk?
Exactly. Yes. If you are to the point where you need the income and you're retired, and the dividend portfolio is maybe supplemental income or something like that, and you're closer to that retirement goal, that's where some of the higher yielding investments can be in your favor. But like I said, often when most people are getting started, and you don't have to be young to get started, you can be at whatever age to get started in dividends. But a lot of times it's some younger people that find it on social medias or YouTubes or wherever they're finding it, and they get attracted to these higher yields. And like Chad was saying, it's the opportunity cost. It's not necessarily that it doesn't even necessarily mean that your investment lost you money. It's just, if you would have had a different strategy, what could you have made? I really hope you all enjoyed that clip. Please make sure you guys leave a like on the video, as it helps me grow my channel. And don't forget to subscribe for dividend related content and other interviews. If you're interested in being added to the interview list, send me an email at dividendobsession@gmail.com and I'll be in touch. Again, this was just a short clip of the full interview. If you're interested in the full interview, check that out right here. But until next time, see ya.